Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us today. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Canada's media regulator has unveiled new rules requiring streaming platforms to devote a larger share of their Canadian revenues to domestic and Indigenous programming. Under the CRTC's new framework, online streaming services will be required to direct 15% of Canadian revenue towards supporting Canadian content. Traditional broadcasters will also see their minimum spending requirements lowered to 25%. Canadian retail sales rose in March, but surging gasoline prices appear to be increasingly eating into household budgets. Retail sales rose 0.9%. Stats Canada is estimating sales rose another 0.6% in April. Now in March, sales were up in 4 of 9 sectors, led by a sharp increase at gasoline stations and fuel vendors. Shares of CAE are trading down in today's trading. That's after the flight simulator reported profit in its most recent quarter that fell compared to the year before. The Montreal-based company also plans to increase operating income by 30% or more by 2030, targeting as much as $1 billion. CAE says the strategy will include a greater focus on defense clients. Some investors are expressing concerns over the long-term outlook, citing limited contribution from organic growth. And a quick look at the markets, all of them not necessarily into record territory, but right around it, pushing up toward it. TSX ending the looks like it was up earlier, better than this, but it's barely on the plus side right now. We'll see what happens through the afternoon. BlackBerry's leading the way, though, up 11%. South of the border, and you can see again, they're all well solidly into the green. The S&P 500 up by a half point, Dow by about 0.63, and the NASDAQ as well up by a half point. Kevin Warsh will be sworn in today as the new Fed chair, succeeding Jerome Powell. Will he be able to balance rising inflation, high oil prices, and Donald Trump's expectations of rate cuts? Joining us now to discuss that and more is Adam Turnquist, partner at Lightwater Partners. And Adam, thanks very much for joining us.
Hey, good morning. Thanks for having me.
All right, let's talk about Warsh. He's getting sworn in this hour. What do you think his biggest challenges are?
Well, big day for Fed watchers with him getting signed in today, and he's got a lot of challenges on his plate. He's called for this regime change at the Fed, talking about the Fed staying in their lane, more on the monetary side, not veering into the fiscal or social side of things. But at the end of the day, he's got to battle inflation, and that's one of the Fed's dual mandates. And right now, obviously, inflation running much hotter than expected. I think the market originally, when he was assigned or appointed, assumed he was going to move the needle in terms of Fed rate cuts. Now the market telling a much different story. So it's going to be an interesting setup for him as he gets sworn in today.
And does the market want to see solidarity from the committee?
For the most part, and I don't think you're going to get it for a while. I think that's going to be a big question mark and maybe create some volatility. How much can he persuade the other voting members to presumably take a more dovish outlook? He's more on the supply side of economics and keeping rates low. So when you look at inflation right now, I think it's a pretty hard argument to come into the next meeting and say, look, we need to start cutting rates when you have wholesale inflation at 6%, Brent crude prices above 100, and trending in the wrong direction. So we think it's probably a higher for longer type regime until we start to see clear evidence of inflation moving lower, of course, supported by lower oil prices.
And with the oil, so you see oil staying up for a while then, even with the latest round of hope, I guess.
For now, look, we like to use technical analysis to define objectively where the market is. And oil clearly in an uptrend. We have not seen any major technical damage. We're watching on Brent crude prices to break below 98. I think that would be a really good step in the right direction, suggesting, look, the top has probably been made. We can start thinking about where is oil going to settle in? What's the geopolitical risk premium? And then you look at the forward curve in oil markets. Going back to Brent, December contracts still trading around $90. That's up almost $10 from a month ago, materially higher before the war when we were pricing in low 70 type December contracts. So higher for longer regime certainly is the message playing out in the oil market.
That, well, obviously, I guess, and that's putting pressure on the inflation. Let's talk a little bit about the Treasury yields. Where does that factor in with everything that's unfolding?
So I would say from a technical perspective, what's happening in interest rates is even more concerning from a macro perspective than what we're seeing in oil. You have the front end of the curve, which is, of course, the most sensitive to monetary policy. Look at 2-year yields breaking out from a bottom, reversing a downtrend. And now we're tracking well above the Fed funds target rate at 3.75, 2-year yields north of 4%. That's basically the market telling the Fed to hike interest rates. That's what we witnessed in the fall of 2021 when we had Russia-Ukraine breaking out, oil surging, and of course we know what followed. So that's the message from the fixed income market. Our collective view here at LPL Research is, look, that we could potentially see Fed rate cuts this year still, but we are going to need to see, again, a resolution, oil flowing through the Strait of Hormuz, and inflation to start moving lower.
And there's a lot of optimism, I think, for that to happen, and it sounds like a lot needs to be in place for that to.
Probabilities are fading quickly.
And so then we look at the markets themselves, the S&P 500, with everything that's unfolding. Then where do we leave that?
Right now, the equity market's focused on the micro, and it's a great story. When you look at earnings, the S&P 500 basically wrapping up Q1, almost 30% earnings growth in a quarter where we had a war breaking out, we had oil surging, we had a lot of question marks on the consumer, but we learned from corporate America they're doing quite well. They're holding margins very well. They're actually expanding despite some of these higher costs. It's been a tech-driven earnings growth story, but if you look at the S&P 493, you take out those mega cap names of the Mag 7, and you're still looking at very solid growth, not only for this quarter, but for this year. So it's hard to argue with the fundamentals right now, despite what's going on in the macro environment.
So you're not worried too much about the Mag 7 then, what they're doing, because they're going like gangbusters right now?
Right, no, they're just breaking out. So a lot of people are benchmarking this rally off the March lows, but I would push back and argue technically they're really just breaking out. The last time they really made a new material high was in October. They were in a downtrend, a corrective phase, and now we've had a resurgence in the mega cap leadership. You're seeing a big breakout, 2 new highs. So I think that's supportive of the broader market. It's very reflective of what happened in April of 2025. The mega caps led on the way down, and now they're leading on the way out, very similar to April 2025, where we had big tech make a big comeback, and that's really what we're seeing and how we're positioning our portfolios here at LPL.
And with the 493, is it fairly balanced? The earnings there too, the increases there, is it fairly balanced?
Yeah, so double-digit earnings growth there. It's been broadening out. We know that the mega caps, they have so much free cash flow did until they started issuing a lot of debt, but they have a lot of earnings power. So that's really pushing the overall earnings growth rate up. But look, it has been beyond the mega cap names. You're seeing solid earnings growth really almost across the board, and even better than expected coming into the quarter. So most sectors had positive revisions even after all of the geopolitical conflict and what's happening in rates and oil. Corporate America is managing through this quite well. Hopefully we can get some type of resolution and the Strait of Hormuz opened up again, and we can get back to hopefully a lower inflation trajectory. And
you mentioned about the debt with the Mag 7. Any concerns with that?
Not really, especially on a longer term basis. Look, we've had a huge rally, so when you have that type of rate of change, it does correct or pullbacks, and maybe a pause in momentum certainly comes with the territory. But again, we think the space is really just starting to break out. We look at the AI CapEx cycle that's supporting that view. We think there's plenty of runway when you look at AI adoption rates going down outside of the tech sector. There's a lot of runway for further spending. We've heard that from most of the hyperscalers as well in this AI arms race. And you look at the CapEx numbers, they continue to move higher. We're looking at almost $800 billion in spending this year, materially higher if you were looking at those numbers just a few quarters ago.
All right, we have to wrap it up there, Adam, but thanks very much for joining us. Have yourself a great weekend.
Yeah, you too. Thanks for having me.
Adam Turnquist is Chief Technical Strategist at LPL Financial. Coming up, SpaceX files for the biggest IPO in history, chasing a $28 trillion market. How much is achievable and how much is just hype? That's next. History in the making as SpaceX officially files to go public, looking for up to $2 trillion in valuation and chasing trillions in market opportunity spanning space, global connectivity, and AI. As Tesla struggles to fulfill its AI promises, can SpaceX actually deliver it? Joining us now is Dan Ives, Global Head of Tech Research at Wedbush. Dan, thanks as always for joining us.
Great to be here.
So, shooting for the moon with this, can he hit it?
The moon?
Beyond Mars. We're going to Mars. I know, but it's the saying, shoot for the moon.
I get it.
Shoot for Mars.
Look, this is going to be, it's a watershed event, not just for Musk, not just for SpaceX, but I think the broader, the broader sector of space. I mean, we're talking about data centers in space in the next 3 years. So that, to me, is the best way to think about it. And this is all derivative of fourth industrial revolution with AI. And it just speaks to, we're still in the early part of this AI revolution.
And so do you think that $2 trillion valuation may be light then?
Look, I think investors are going to be able to look around the corner. And if you're a believer, then that would be, I think, very conservative relative to, I think, how a lot of investors view the broader opportunity. Now, look, for them, it's going to be execution, right? If you look at numbers today for SpaceX, you're not going to be able to justify any of these valuations. But you have to look beyond it. What's it going to look like in the next 2 years, 3 years, 4 years, and so on. Look, for those that bet against Musk and Tesla, that was a historic wrong bet, right? So the point is, that's like betting against Tom Brady coming out of Michigan, 2000. So I'm just saying, like, investors now, they're betting Musk as much as SpaceX.
And that's it. But is Musk the bet right now? Is it a good bet?
It's like, it would be like betting on Gretzky or betting on Mahomes in football. I mean, you're betting on what's not just one of the leaders in tech, one of the leaders in the broader disruptive future. And it goes back to, like, look, many investors, they bet against Musk and Tesla, said electric vehicles can never happen. Look where we are today. So betting against Musk, I think that's the wrong bet. And I think, look, SpaceX, where's the competition coming from? They're essentially the foundation for space, almost globally.
So what does he need to do then to make this work, to get it off the ground, so to speak? What do you want to see as the first accomplishment?
The big thing is, like, look, so much of this is going to be driven around data, Starlink, the data center build out, almost a convergence of tech and space. You've seen a huge part of the execution, but we're still in the early days. So as you have evaluation, and depending on how the IPO goes, there's going to be more and more execution that they're going to have to do. But it's also our view, 2027, more than an 80% chance SpaceX and Tesla merge.
I wanted to ask you about that. Is that realistic, and where does that take them?
Look, I mean, now it must be putting the whole AI ecosystem under one hood. And then that's the smart move, not just in terms of cross-pollination within engineers, but it's around data. And look, XAI, SpaceX, now SpaceX, Tesla, to me, that's the move that would take this to the next level. And I think SpaceX IPO is the first step.
And now, I mean, you talked about Tesla at the beginning, but we've talked about autonomous robo-taxis. We're starting to see them, but it's taken a while. Is there the chance that this may not go as smooth as some people are hoping?
Look, there's always going to be speed bumps. But I think the reality is that Tesla over time is going to dominate the autonomous market because of the scale and scope. And I think that it speaks to our view, $600 base case, $800 bull case for Tesla as it all plays out.
And with the IPO, we've got probably OpenAI, Anthropic coming as well. Do people hold their money, or do you see the rush there, and then maybe they pay the price? That you see the rush to SpaceX, and the other two pay the price?
I think you're talking about three generational type of companies, right? I mean, you at the core of the AI revolution, OpenAI, Anthropic, when you think about SpaceX and overall space, as well as Musk. But for me, we're in year 3 of a 10-year build out of the AI revolution. And that's why, like, anytime we talk about macro issues, whether it's Iran, oil, rates, these dips are going to continue to get bought, right? And the bears in hibernation mode will continue to miss this historic bull market.
All right, I want to get in a couple of questions about Zoom. They had a revenue beat, raised their full year guidance. Is that AI driving it? Are they making the transition properly?
Transition properly. I remember they also have like some of their AI bets, Anthropic and others. So like those have been very significant relative to valuation. Zoom, that turnaround's actually started now. And I think that's why we continue to be very positive on the name.
What do you like the most about it? What are they doing right?
You have the install base, you have the brand, and now it's really about monetization conversion, but integrating AI, because you always hear about, and the worry is SaaS apocalypse and what Anthropic's doing, and Zoom, for them, they're actually going to be on the right side of this in terms of monetization when it comes to AI, not just from an investment perspective, but also when it comes to technology.
All right, Dan, we got to wrap it up there, but thanks very much for joining us. Have a great weekend.
Thank you. You
Dan,
too.
Cheers. Dan Ives, Global Head of Tech Research at Wedbush. Coming up, a jump in gas prices has taken a bite out of household spending. We'll break down the latest retail data from Stats Canada when we come back. A new report from Stats Canada says that Canadian retail sales rose by 0.9% in March, even though higher inflation, United States tariffs, and geopolitical tensions are affecting the economy. For analysis and reaction, we were joined earlier by Charles St-Arnaud, Chief Economist at Service.
Most of the economists on the market was expecting. I think when you look at the details of the number, the surprise is not necessarily a positive surprise. It's clear that's been driven by higher gasoline prices rather than actually stronger underlying spending from households.
And with the gas, how much of an impact is gas having?
Well, you can see it, like the core measure, so excluding motor vehicle sales and sales at gasoline station, is actually slightly negative at minus 0.1 compared to a strong number of plus 0.9 on the overall. So it's clear that most of it is due to price increase at the pump. And when you see it also in the retail sales in volume, which are also declining on the month. So it's clear that what has been pushing retail sales higher in March has been almost entirely price effect.
Charles, here we are, May 22nd. The straits are still closed. Oil prices and gasoline prices are still high. I think I saw like close to $2.
Getting there.
Yeah. So, you know, obviously looking backwards is important, but looking forwards, what do you see, of course, for retail sales? And are we going to start to see a big impact as this drags on longer with the higher gasoline prices?
Yeah, well, that's where it's interesting is that we can see, unfortunately, retail sales is one of those nominal variable. Like I was looking at the forward-looking component of the report, so the preliminary estimates for April is another solid positive number. But again, that's a nominal number. How much of that is, again, driven by those price effect will be, is probably likely a big part of that. So, and the problem for when we look more under the hood for retail sales is that the longer oil prices remain high, the longer those gasoline prices remain high, the more it continues to squeeze households and reducing their purchasing power. And that will start to be a big headwind on spending going forward.
And is there any area that kind of stood out? We expected the gas, no real surprise, but any areas that stood out for drops, sectors for drops or larger growth?
No, well, I think the drop in auto sales were expected. We had seen from other preliminary number that auto sales had kind of compensated for we had a rebound in February, and it was showing a decline in March. So that was kind of expected. But throughout the board, you're seeing some underlying weakness, which shows that already in March, already as the oil shock was starting, that consumers were not necessarily on the strongest footing. And that, in some ways, it's kind of, you have to look in there in terms of how much of it is part of a payback from a very strong start of the year in terms of consumer spending. So both January and February were relatively strong in real terms. So how much of it is a bit of a payback on that period, we'll have to see. But it seems that oil shock is really a big headwind for consumers.
Most Canadians obviously care about how much money they're spending at restaurants and groceries, as well as the gasoline. What kind of relief can we expect going forward, or is there ever going to be any relief here? When you go to the grocery stores, the prices don't seem to come down. The Canadian dollar obviously still kind of weak against the U.S. dollar. Where does this end for Canadians?
Yeah, that's where it becomes problematic. Like, I don't think we're going to see price decline on food prices. There's a lot of structural problem in that sector, whether it's beef prices are not going to come down because there's the size of the cattle herd in North America hasn't been this small in decades. So obviously supply is not there to meet the demand. We also have higher cost of fertilizer, higher cost of energy is also a big source of input for that sector. So we shouldn't be expecting any big relief on that front. But then, as long as our energy prices remains high, we have to remember that in a country like Canada, everything we consume needs to be transported on vast distance. So with those higher transportation costs, some of it will have to be passed through to consumers. So as long as the Strait of Hormuz is closed, as long as we don't see some normalization in energy prices, we're going to continue to see some pressure on inflation. And that's where the concern will be for the Bank of Canada is, do we start to see some second round effect? We haven't seen it so far. The CPI earlier this week kind of clearly showed that core measures were actually weaker than what most were expecting.
And so with the Bank of Canada, I mean, obviously they're in a holding pattern right now. How long can they stay in that holding pattern, do you think, with everything that's unfolding?
I think they can stay on the hold for a long period of time. The way I kind of see the Bank of Canada is they're facing a tug of war between two inflationary factors. On one side, the Canadian economy is still relatively weak. We still have excess supply. We have a labor market that is not performing very well. We actually lost 120,000 jobs so far this year. So that should be overall like deflationary for the system. But on the flip side, we have those higher gasoline prices, higher transportation costs that have the risk of feeding into broader inflationary pressure later this year. So they need to balance those two risks. So, and when you look at overall, it makes a lot of sense for the Bank of Canada to be patient, keeping steady where they are for at least the rest of the year.
And is a hike more likely than a cut at this point with what we're seeing, with the numbers we're seeing towards the end of the year? Or is it we still wait and see?
Well, that's where it's complicated. The probability for the Bank of Canada hinge really on what's the probability of seeing the Strait of Hormuz reopening. If we think that a normalization in energy prices will happen rapidly, then the probability of cuts probably increase. But if the disruption in the Strait of Hormuz continues for a longer period of time, then you start to see increasing probability of a hike. So that's where it's not just hinging on Canadian domestic factor. There's a lot of factors that are out of our control that will decide where monetary policy goes going forward.
That was Charles St. Arnaud, chief economist at Service, co-hosted by Barry Schwartz, president and CIO at Baskin Wealth Management. Up next, is AI set to disrupt the job market or reshape it for the better? We'll discuss more after the break. Slate Grocery REIT is considering a range of options. The Toronto-based real estate investment trust says it has formed a special committee to consider strategic alternatives after receiving an unsolicited takeover offer from its external manager, Slate Asset Management. Slate says it is considering a range of options, including a possible sale of the company It owns and operates U.S. grocery-anchored real estate. Shares of IMAX are surging today, up 15%. There are numerous reports the film distributor is exploring a sale and has approached entertainment companies as potential buyers. IMAX's search for a buyer comes as premium theater experiences are growing faster than the overall box office. Movies have grossed about $2.9 billion U.S. domestically this year, the highest total for the same period since before the pandemic. Shares of Zoom are rallying, up almost 11.5%. The video communications firm raised its annual sales and profit forecast after reporting higher than expected quarterly revenue. Investors note the move signals that customers are increasingly adopting Zoom's expanding suite of workplace software tools. The company has been working to diversify beyond video meetings by expanding into products like business phone systems, contact center software, and AI-powered workplace tools. And quick look at the markets. The TSX up again. It was hovering right around break even, but back up by a quarter point south of the border. They're still solidly into the green today, pushing into or near record territory. Artificial intelligence could replace a range of jobs over the next decade, but maybe not trigger widespread disruption. Instead, it's being seen as a gradual shift that may boost productivity and create new opportunities. Earlier, Bloomberg spoke with Sander van Toornend, CEO of recruitment giant Randstad. Here's more of that conversation.
AI will have an impact on jobs and labor. What we see is an impact of 7-8% in the base case over the next 5 to 10 years. And that's massive, but it's not the massive doomsday scenario that some people would like you to believe. And yes, administrative work, marketing, content, programming, software development, customer service, they will be impacted by AI, yes.
But is that why we're seeing layoffs now? And we talk about AI, washing, which is the fact that if I'm a chief executive, I want to get rid of 10% of my workforce. Instead of saying, well, I want to get rid of 10% of my workforce, I use AI as an excuse.
I think there's three elements. There's some of the washing element, because AI adoption takes time, and AI adoption at scale is maybe the case in a few bigger organizations and not in many other organizations. I think then there's the AI, let's say, focusing on productivity. Yeah. But there's also, especially the tech companies, they're pivoting their companies towards AI, and that means they are downscaling other initiatives in their business.
When do we reach peak? And is there a danger? So this makes me think of COVID, right? In COVID, we were all stuck at home, and you have big companies that laid off too many workers. And lo and behold, there was trouble because they didn't have enough good workers when everything reopened. Is there the same danger with AI?
I would not say so. I think AI is going to be something like a wave over the next 5, 10, 15 years. Think back to the .com and the digital era that we are in now. Yeah. It took Amazon 25 years to get to where they got to. I think AI can go a lot faster, but it will take years.
But who exactly is there anyone who's not at risk of losing their job or having their job significantly impacted?
Well, let's not forget there are lots of opportunities as well. First of all, AI enables many workers, whether you're in customer service or you're a knowledge worker in a law firm, to do a much better job and a much more productive job. Then the flip side of the coin, AI requires massive infrastructure. Yeah. That means there's opportunities for people in the skilled trades, your HVAC technicians, your maintenance engineers, and things like that. So there are opportunities. And then I always say I'm an AI optimist. Yeah. Meaning the world is in dire need of a productivity boost. Yes. Because populations are going to shrink, are shrinking, so we need to do more work for fewer people need to do more work for more people. And that's in healthcare, that is in the skilled trade, it's in hospitality, it's all those sectors where there is going to be massive demand.
Do you worry about the human connection? That actually, yes, I have a computer that can be much better at giving me solutions than maybe a junior or an assistant, but is it good for humanity, or is it better for me to still speak and interface with a human?
Yeah, well, I would say in our business, we are a case in point.
Yeah.
So AI is helping our recruiters to be more productive, to be more efficient, and make more value in the human connection. So spend more quality time with candidates and with clients versus doing administrative work. So I think human connection will always be important, and the quality of the human connection supported by AI will become better.
Sandra, do you worry about youth? So this is, especially in the UK, it's actually the employment of the graduates that are just coming out of university that's probably most at risk. Now, this could be for a number of reasons, because chief executives are also spending so much money in AI just to build it, that they may be using that money instead of recruiting graduates. But it's also a natural process if it's the more junior jobs that go.
I would say, and this is actually our research shows this is tremendous opportunity for younger people, because if they build AI skills, and we say AI is a fast path to pay and promotion, they can get higher pay and they can get promoted faster and they can overtake some of the more senior people in the job.
But there'll be less of them.
Not per se.
The graduate product,
Not per se. Actually, graduate unemployment in the US has come down by 200 basis points over the last couple of quarters.
So what was your first job, Sander?
My first job was a programmer at Accenture.
But so at the time, did you enter the workforce with proper skills, or was it a little bit of, were you trained on the job? And
no, training on the job I think will still be important. I think the interesting thing today is that people can acquire skills online on themselves, on their own merits. They don't need anyone to tell them, and that's what we see younger people do. I was talking to a CEO of a big consulting firm the other day, and he said, well, our younger people are actually much better at applying AI to the jobs that we do than some of the more senior people. So I'm optimistic for younger people, provided that they combine the AI skills with more social skills, empathy, collaboration, judgment. So,
what should they study? This is another conversation, because the workforce in 5 years, because of how they learn at school through AI, is also going to be vastly different to how you and I started out in the workforce.
I would say science and technology is still a good place to be. I would say the skilled trades are a good place to be. Skilled trades can go up into the six figures these days, so that's massive. Healthcare, and I would say people working with people in general is a good place to be.
Yeah, so this face-to-face is always here to stay. How do you anticipate what's coming next? Because behind closed doors, a lot of chief executives will tell you, look, we're still trying to figure it out. So the pace of change can be very, very quick, but they don't 100% know exactly where it lands.
No, nobody knows where this is going to land, as we didn't know that for the .com and the digital era either. I think for executives it's very important to have a bit of a plan, so to speak. Yeah. Where do you see the application of AI in your business? And I would like to focus on, at least in our business, we're focusing on the experience for the customer and the experience for the talent. Because if we do a better job for those two, then almost automatically we will get the efficiency rewards. But that's our approach. I mean, I can imagine if you're a big bank and you have a big factory, quote unquote, that you want to apply AI to that.
Sander, whose job is it to retrain, and how quickly, how difficult is it to retrain when you don't really know the jobs of tomorrow?
I think it's business and policymakers, government, education systems working together to make that happen, because we have to do a much better job this time around than previous rounds when we had the whole manufacturing, technology, China discussion. So we should learn the lessons from that era and apply them at scale now.
That was the CEO of Randstad, Sander van 't Noordende. Coming up, Canadian banks are heading into Q2 earnings, trading near all-time highs. But is this just the calm before the storm? That's after the break. Next week, Canada's biggest banks report earnings. Despite economic slowdowns and trade tensions, stock prices are at an all-time high. But with CUSMA, uncertainty and high inflation looming, can the rally last? To find out more, we sat down earlier with John Aiken, Director of Research at Canadian Financials at Jefferies.
as we started into the fiscal 2026 for the Canadian banks, expectation was that the first half of the year was going to be solid, as we've seen. Q1 results were solid. Expectations are the second quarter is going to be solid as well. But the market had been expecting the second half to be a lot better, leading into more normalized growth into 2027. However, as we sit here today, when the banks were reporting their first quarter earnings, the war was not actually going on. We didn't have higher gas prices, and this is now something that's going to cast a pall on the outlook, at least from our standpoint. And if the executive teams are not universally constructive on the outlook for the second half of the year, investors are going to have to shift their outlook, their sentiment, which with the Canadian banks trading at near peak multiples could actually cause some softness in the valuations. That's our concern, that the outlook for 2027 may not look as rosy, coming out of the second quarter earnings as it was coming out of the first quarter earnings.
You also say you don't expect relief on the credit front just yet, but it sounds as though you don't expect it to get any worse either. Is that right?
That is our base case scenario. However, if you're going to push me one way or the other, given the fact that inflation remains sticky, we may actually have the Bank of Canada raise rates through the end of the year, causing the outlook for stagflation. No, I actually think the risk is for higher credit costs, more so than them declining from what we've got in our estimates. That being said, though, the Canadian economy has been very resilient, more so than we would have expected. And while the credit costs remain high, they're not falling off the cliff, and obviously not causing any panic in the market, because obviously investors are still willing to pay up for the bank shares.
We've been seeing Canadian bank valuations sitting at near or historic highs right now. Do you think, is that justified at the moment?
On a fundamental basis, no, we think that they're edging into the overpriced territory. However, you can't look at this in isolation, where right now money is still flowing into equities, but with a lack of breadth within the S&P TSX, the Canadian banks still are viewed as a defensive stance, even though they are exposed to credit. We also do believe that the banks in general have done a very good job in terms of improving their profitability levels. When you look at their ROEs, on top of a capital base that is much stronger than it was a decade ago. So you can take two sides of the coin. It just depends on what your outlook is for the macro. If it's going to get worse, no, they're overvalued, it's going to come through. If you think the macro is going to go into a soft landing, then no, you can justify these valuations. The valuations just may have to earn into it in earnings into 2027.
And I wonder too, like, are these banks all on the same footing as we head into the latest earnings period, or are we going to start to see a split between like clear winners and losers?
Well, given the fact that we're still in an environment where we're not expecting strong top-line growth, they're pretty much all in the mix. However, we could probably see some differentiation in the second half of the year, depending on how Canada performs versus the U.S. or the globe, whether or not we still have resilience in wealth management capital markets. But one thing that we do note is actually there's a bit of a division within the banks in terms of returning capital, where we have three banks, Bank of Montreal, TD, and National, that have stated that they're planning on aggressively returning capital to shareholders via buybacks, more so than the peer group. And that should benefit their ROEs as they're shrinking their denominator, but also help to boost their valuations. And we'll see whether or not that actually is sufficient to cause some shift in the relative valuation multiples of those three versus the three that are not as aggressive.
I'm not sure if you want to say, but is there one that you like more than the others, or a couple that you feel more strongly? Is it TD that you maybe feel more strongly about?
We do think that TD sets up very well for the quarter. If we're going to go over the longer term, though, with a year out, we're probably going to take a much more defensive stance with either Royal or National Bank.
And which one do you think might be the loser, I guess, maybe of the big six?
Well, right, loser's probably too strong, but the one that's facing headwinds that are likely to persist in the second quarter is Bank of Nova Scotia, just as they're trying to transform their international operations largely in Latin America. We do think that they will be successful, but this is causing some headwinds and indigestion in the near term, and we see that in the relative valuation multiple and their performance.
Do you think we're kind of getting to that point where it's inevitable that we see more of a split between these banks, which have been on par with each other for such a long time now?
I may have argued that over the past decade or so, given the fact that there are dramatically different strategies and risk rewards entailing in that, but they have, by and large, traded in conjunction with each other. We do think that there's an opportunity for division, but right now, until we actually start to see better top line growth and separation that way, we do think they're going to trade in line probably for the next 6 months or so.
Okay, so looking at your coverage, you have a hold rating across the board. So is there any specific catalyst that it would take for you to upgrade at least one of these names to a buy?
Yes, it would be a return to more normalized credit levels sooner rather than later. That would definitely boost the outlook for 2027 and ease the price to earnings multiple pressure. That being said, we could also see an even step function on return to capital because we do think the Canadian banks are overcapitalized, even with our concern in the outlook. And I think that the return to capital story, even more so than what TD has done to date, would definitely be able to justify us increasing our target price and getting a more sizable return.
And Lindsay was speaking with John Aiken, Director of Research, Canadian Financials at Jefferies. Coming up, Canadian stocks hit a fresh record powered by banks, tech, and a surge in energy. We'll have more after the break. Canada's benchmark stock index climbed to a new high today before pulling back slightly, but it's inching back up. Let's get more on this from Stephanie Hughes of Bloomberg News. Stephanie, thanks as always for joining us.
Hey, good to see you, Roger.
All right, what's driving this? It's having a nice little run, isn't it?
Yeah, it's a pretty good run. It's in fact an all-time high, the first all-time high since March 2nd, and it's really this recent run-up and rally is being driven primarily by financial firms like TD, RBC. They're adding quite a few points to the overall index, and then of course your tech darlings like Shopify. Those have all been adding quite a few points to the index this week. So energy stocks are obviously also doing a bit of heavy lifting here as oil prices had a sharp rally since the outbreak of the Iran war, and also holds the second highest weighting in the TSX, so that it's going to contribute a lot more just based on its size. And when you see tech names, maybe they're getting a little bit of a relief as well, based on the optimism around a potential end of the conflict in the Middle East. I know that's been a huge topic this week, and even before that, before this week, it's kind of an ongoing development, but traders are really keeping a keen eye on that. So. And the other thing too, what's supporting Canadian stocks is that traders are pretty happy and analysts are pretty happy about the strength and quality of the earnings that we're seeing so far in Canadian earnings season, and that'll be kind of wrapped up once the banks report those earnings next week. So as it stands right now, it's a bit of a tug of war between the rallying infotech sector and lagging materials sector, which includes miners, of course. And BlackBerry today by far the top performer on the TSX. So we'll have to see if that index stays in the green as the day goes on. But yeah, managed to get to a new all-time high, Roger.
All right, and most people love when the markets go up, but the strategists like the way it's going up?
Yeah, they're pretty confident or optimistic about the quality of the rally so far, saying it's kind of broad based. We had Greg Taylor, the chief investment officer from Pendafund Capital, saying it's probably a healthier rally, as he described it, just because it's more broadly based. It's not just one sector doing the heavy lifting. There's a few factors kind of contributing to that upswing. And then Philip Peterson from IG Wealth Management, he said. In total, it's a combination of strong results, potential end of the war, just contributing to the TSX reaching that all-time high. And then he also added that overall, if not for gold, which ironically is now being treated by investors as something of a risk-on asset, TSX would be even higher than that. Obviously, we saw the TSX rallying very strongly because of gold prices just hitting, back-to-back all-time highs. It was a really good showing for precious metals last year, based on uncertainty and also the central banks lowering rates. Gold is an asset that really thrives in that kind of environment as an asset that doesn't really yield. So yeah, it's even though gold is coming off, it's not quite at its all-time high anymore. TSX is still chugging along. It's still showing some strength, and it's finding other pockets to do so, Roger.
All right, we'll leave it at that. Stephanie, thanks as always. Have yourself a great weekend.
You too.
Stephanie Hughes from Bloomberg News. Well, the CRTC is raising the cost for streaming companies to support Canadian content. CTV's Abigail Beeman has more on what it could mean for Canada-U.S. trade talks.
This will triple the amount of money streaming companies will have to pay when some are already battling the current rules in court, and the whole issue is a thorn in the side of Canada-U.S. trade talks. As part of an effort to bring broadcasting rules into the digital age, the Canadian Radio, Television and Telecommunications Commission says digital streaming giants such as Netflix and Disney will have to pay 15% of their Canadian revenue to support programming in this country. That was previously set at 5%, but no one has benefited from the money, which is sitting in trust while the streamers fight the decision in court. Meanwhile, the Trump administration has long railed against the Online Streaming Act, calling it a trade irritant on a list of contentious issues ahead of a July 1st deadline for a review of the Canada-US-Mexico free trade deal. As for traditional private broadcasters, including CTV News, the CRTC has lowered the amount to 25% of revenues, with a whole host of new rules about how that money is spent. The old amount was between 30 and 45%.
And that was CTV's Abigail Beeman. Now, market calls coming up next. Today on the show, we have Martin Cobb. He's Senior Vice President, Equities at Lawrence Steinberg Wealth Management. He'll be taking your questions on global and North American equities. All right, that is it for Morning Markets. Thanks for joining us today. Have yourself a great weekend. We'll see you on Monday.